Let's look at the same problem, except let's assume the company uses double declining balance. So on April 10th, 2012, we purchased equipment for $120,000. The equipment has a 10-year life and a $12,000 salvage value. Calculate depreciation for 2012 and 2013 using the double declining balance method. Well, first off, again, let's review the double declining balance formula. Double declining balance, remember we take 2 divided by useful life in years, and we multiply that by cost minus accumulated depreciation. Remember we said cost minus accumulated depreciation is the same thing as the book value. So 2 over useful life in years times cost minus accumulated depreciation. Or 2 over useful life in years times the book value, however you want to look at that. So let's look at this. Remember there's 3 things we need. We need to know the cost, the salvage value, and the useful life. The cost here is $120,000. The salvage value we said is $12,000. And the useful life is 10 years. So let's look at the formula for double declining balance. First, we're going to take 2 divided by useful life in years. So 2 divided by 10. And we're going to multiply that by the cost, and we know the cost to be $120,000. And we're going to subtract out 0. Why 0? Well, remember, it's cost minus accumulated depreciation. This asset is in its first year of life, so we have not yet depreciated. So at this moment, accumulated depreciation is indeed 0. When we multiply that out, we get 0.2 times 120,000, which gives us 24,000. Now again, that 24,000 represents the per year. So again, we purchased on April 10th. We only held it for partial year. Since it was April 10th, again, it's the majority of April, so we're going to count all of April. April through December, we've already determined to be 9/12. So take 24,000 times 9/12, and that's going to give us 18,000 for 2012. Now let's look at 2013, because in this method it's going to change every year. It's not like straight line method. So if we do 2013, again, double declining balance would equal 2 over 10, which we know to be 0.2, times the cost, which is 120,000, minus 18,000. Again, that's our accumulated depreciation to this point. So that gives us 0.2 times 102,000, which gives us 20,400. So 20,400 would actually be our depreciation expense for the year. So let's review. 2012, 2013. We found out that the depreciation expense for 2012 we said was 18,000. Remember the original 24,000 we prorated by 9/12. That brings our accumulated depreciation to 18,000. We used that 18,000 in accumulated depreciation to calculate the next year's depreciation, which was 20,400 in total. Now, what does that bring our accumulated depreciation to? Well, again, keep in mind you're going to take this 18,000 here, and you're going to add it to the 20,400, and that's going to give us our new depreciation of 38,400. So accumulated depreciation is the sum of all years' expenses. Okay? Now, what happens in 2014? Well, again, it didn't ask us to do 2014, but let's look at that so that you can see the flow of the information here. Double declining, again, would be 2 over 10, but in this case, it's going to be times 120 minus 38,400. Remember, we simply bring down that accumulated depreciation, and that's what we'll use. So make sure you update that number every single time. So that gave us 0.2 times 81,600, which gives us 16,320 in 2014. Now, let's look at one more thing here. How do we actually go in and journalize depreciation? Well, remember, the journal is not impacted by the actual method, so all we need to do in this case, if we were to look at our journal, I'm going to put this in gray here, we have our date, and our date in this case is, well, let's look at a couple of things here. We're going to play it by ear on this last slide. We got the account and debit, credit. Let's start with the journal entry to purchase. So on April 10th, we would actually do our account equipment, and we would put that equipment on at the $120,000 cost. And then we would do cash, or it could be a note payable or account payable. It doesn't say, but let's assume cash for 120. Now that asset's going to sit there until December 31st, 2012. That's actually where that depreciation comes into play. On that date, no matter what method we use, you would actually debit depreciation expense, okay, and you would credit what we call the accumulated depreciation. Depreciation expense is an income statement account. Accumulated depreciation is a balance sheet account. Now, again, let's just glance back here and see that in 2012, our depreciation was $18,000. So we're going to do $18,000 and $18,000. And again, it would sit there and we would use it, but then in December 31st, 2013, we'd go in and do it again. Again, it would be depreciation expense, I'm going to abbreviate a little bit, and accumulated depreciation. And again, we calculated that for 2013 to be $20,400. Excuse me. And so forth and so on. You would do that journal entry each year through the asset's entire life.